Big earnings morning. We had Caterpillar, Southwest Airlines, which got crushed, and Mastercard. So these are the ones that we're going to go over right here. Stick around later today. We're going to be hitting Amazon and Intel. So right now, Southwest, yikes. They had a rough quarter, I will say. And it's very apparent in the price reaction. So they lost for the quarter. They lost 27 cents per share. The expectation was to lose 23 cents per share. Revenue came in at $5.7 billion, short of the $5.72 billion expectation. Now, you guys remember in the holiday quarter, remember they had to cancel 16,700 flights, if I'm not mistaken. And the reasoning was their computer system shut down. And just last week or the week before, whatever it was, they had another pause because their computer system shut down. That was only a couple of hours, and I don't think that resulted in many cancellations. But, man, Southwest needs to do something about these computer systems. So right now, they're down about 6%. Let's look at the press release real quick. So net loss of $159 million. All right. Let's see what they have to say about everything that happened with that quarter. Well, let's see here. And guys, as I read these things, I am reading them for the very first time with you. So I would hope that they would talk a lot about what happened with their computer systems, what updates they're going to do to their computer systems. Economic fuel costs. This is a big one. $2.45 to $2.55. They do a great job hedging their fuel costs, so they're not paying the $4, $5, $6 per gallon, whatever it is, whatever they calculate it as in the industry. Let's see what else we have here. Record results in the first quarter. Operating revenue is $5.7 billion, 21.6% increase year over year. That's good. Let's see what else we have here. Despite the negative revenue, approximately $325 million associated with the December 2022 operational disruption. The company's first quarter of 2023 reported strong. So the good news is they're starting to come back. Take out these operational issues that they have with their computers. It seems like they're doing okay. Remember, this is the company that, let's go over the financials. This is the company that made money for, I think it was 32 straight years, and it took a global pandemic for them to lose money in a full year. That's a remarkable statistic. Now it's kind of building back to those levels. So let's see where revenue's at. So revenue is back. Revenue is back from pre-COVID levels, $22.5 billion in 2019, about $24 billion. So revenue is certainly back. I think a lot of that is driven by higher costs. You're seeing it. The last CPI number that came out, travel is still extremely high. So we have to worry about that. Once those travel costs come down, if they ever come down, then you are going to maybe have to worry about where their revenue goes. But I don't think that that's the case. Cash flow. So they're still not generating cash flow, but I think that once things get sorted again, it's going to be okay for them. Here's my question, and all this comes down to this computer system issue. I've been hearing these computer systems are from decades ago. Why is nobody else having these issues? What is it going to take to revamp the systems? What is it going to revamp all of their logistics and stuff? That's a question that needs to be answered before you take any type of investment here. The 8 pillars are not pretty, not surprising in any way. And I would expect analysts to not have a really good idea of where things are going because there's so much uncertainty out there. And you can even see into 2025, there's only 10 analysts. That's not very typical for a company of this stature. You can see the revenue growth is huge. This is going to be a very, very tough. This is earnings per share. Revenue is going to be tough to decide just because of where things are going. So we'll be conservative with it. So let's come over here to Stock Analyzer tool and try to put a number on this bad boy. $29 a share probably seems pretty appealing. Let's go with some revenue. Let's go with 3, 6, and 9. Now, why did I put 3 in there? 3 is extremely low. 9 is extremely high. Because there's a lot of uncertainty over the next decade for them. They're coming out of something. They could be going into something. That's why I have to kind of run the gamut here. Profit margin. I'm going to go 94 equals 4, 6, and 8. Free cash flow margin, I'm going to do the same thing because I think that over time, those should stabilize. 15, 16, and 17. 15, 16, 17 for price to free cash flow. And my return, I'm going to put in 10 here because 3% is very low growth. 12, and I'll go 14 because I do think 9% is kind of high. Let's see what we spit out. And here, this makes a lot of sense. This has been very consistent since COVID. $22 on the low end, $56 on the high end, $35 in the middle. This has been an interesting one. I own them. I bought them at $25, ended up selling somewhere around $40. I think it was dumb luck, but now they're back to these levels, and maybe I run it again. But this is a very interesting company. Next one, Mastercard. So everybody has Mastercard. I don't think I have. Actually, I don't. Maybe not everybody has a Mastercard. Visa, American. I don't have a Mastercard. Well, I'm not buying Mastercard. Just kidding. All right, let's see. Up 2% right now. Let's see what they had to say in their quarterly report. So first of all, $2.80 versus $2.71, $5.7 billion versus $5.64 billion. That's a beat. Not surprising because of what the number just came out this morning. Spending is still very high. It went up 3.7% in the last quarter. So people are still spending, and I think they're spending a lot on credit cards, Mastercard being one of them. I do actually have a Mastercard. It's the Apple credit card. First quarter net income, $2.4 billion. Earnings per share, $2.47. Net income, $2.7 billion. Let's see. Okay, let's get into some more of the thick of it. This is going to be the first company they're like moving away from first round PVC credit cards by 2027. I think that actually helped them in some way for some reason. But let's see. Operating expenses increased 18%. That's probably just because costs are higher. Yep, due to higher costs. Operating income was unfavorable, $106 million versus the year ago period. Adjusted income expense was favorable, $30 million versus the prior year. Let's see. First effective tax rate. Let's see. Is there anything else really cool in here? Return of capital to shareholders. Okay. They repurchased $8 million in shares. I'm sorry. They purchased 8 million shares at a cost of $2.9 billion and paid $545 million in dividends. All right. I'm not sure I'm going to love that buyback. The dividend is fine, but the buyback part, I don't really like when companies buy back shares at expensive prices. That doesn't really do a great service to me as a shareholder. And looking at this, PE of 45, 5-year PE of 45, overall 1-year PE of 35, basically 36. I can't say that I love that. Now let's go here to the revenue because I want to make sure we are not getting huge spikes in revenue due to people not having money, so they go and put debt on credit cards or they rely on them a little bit more. Now I look at this and say, okay, let's go back here. 8 billion, 9.5, basically 9.5, 10.75, 12.5, 15, 17, 15, 2020, 19, record high, 22. Those are big jumps. So what does that tell me? When I type in revenue, is this the new norm? Is it the new norm that we're going to have insane credit card spending that's just going to continue forever? I don't think that's the case. So when I do Stock Analyzer, I'm going to taper that back a little bit. Net income, it's skyrocketed. I'm not so sure that they're going to have those net income numbers. Now, they have been buying back shares. I don't really love that, but we'll see. And it's a fantastic company. Look at their gross profit margin, 76%, with a profit margin of 46%. Enterprise value, market cap 355 billion. Enterprise value 380 billion. I'm perfectly fine with that. And these are my favorite pillars to see. They hit on everything, including the most insane in return on invested capital. Little expensive. That's about it. So what does that tell me? Find a price and wait for it. Let's see here what the analysts have to say. Big time earnings per share growth. Mid-teens, mid to high teens. And why is that? It's because they have a 58% return on invested capital. And on the revenue side, big revenue growth. Mid-teens. That's unbelievable. So let's put in some numbers here. I'm going to go 7, 10, and 13. 13 is what analysts are expecting over the next 3 years. I'll put that on my high end. Profit margin. I don't see this really shaking, but let's go 40, 43, and 46. Free cash flow margin. I'm going to do the exact same thing. And 46. PE. Let's go 16, 17, and 18. 16, 17, and 18. 10, 12, and 14% return. Let's see what we have. $375 a share right now. And these numbers absolutely make sense. 191 on the low end, 275 on the high end, 230 in the middle. My watch list price is 200, and based on that 5-year PE, that's 45. Yeah, these numbers make sense. That's where I want to own it. But I think I would pay a little bit of a premium over 200, and the reason being, it's such a great moat. It's such a great brand. There's really only 3 places to go for credit card, 4 if you include Discover Financial, but I'm including Visa, Mastercard, American Express. Okay, the last one, Caterpillar. Caterpillar, $4.91 a share versus $3.08 a share. Boom, that's a beat. $15.86 billion versus $15.01 billion. That's a beat. But see what happened. This is why those of you that are interested in trading, this is why I don't trade earnings, because everything looked wonderful. I mean, that is a crush, absolute crush on top and bottom line, and the stock price is down right now. Now, a couple of things to point out. Instantly, when I saw this morning, before I looked at anything, all I did was see those 2 values that I gave to you, earnings per share and revenue. I said, government spending. It came from the government's infrastructure bill, $550 billion or whatever. That was my initial assumption. I had our analyst Dalton run through it. That was not the case, actually. What we're seeing is supply chains are easing, and they got a big boost in that coming back to their business. So is that a one-time boost that's going to happen? I don't know. That's something you need to figure out when you're looking into this. But let's start paying attention here. Okay, revenues of $768 million, an increase of $116 million or 18% compared with the first quarter of 2022. Wow. Profit increased. It was $149 million, an increase of $6 million or 4% compared with the first quarter of 2022. Wow. Caterpillar crushed. Now, why do I pay attention to Caterpillar? You may be looking at this and saying, hey, you guys really don't do Caterpillar that often, because I think it tells you where the U.S. economy is going. If people are spending to build infrastructure, if they're spending to build buildings, if they're spending to do construction projects, whatever, I think that's one of the leading indicators, and that's why I like to pay attention to Caterpillar. So I haven't looked at Caterpillar in quite some time. It's now down 4.25%. Market cap of $113 billion. Enterprise value of $172 billion. Okay. But they do have a gross profit margin of 29.5%. Profit margin, trailing 12 months, of 11.3%. Pretty interesting PE. Interesting at these levels. They do pay a dividend. I'm comfortable with the dividend that they pay. What's their return on invested capital? 12.6% over 5 years. Okay, this is interesting. This is interesting. Now, the debt is the only thing that we got going for us, but it's a I would imagine it's a capital-intensive business. Total current assets of 43. Okay, let me go here. Looking to see their free cash flow. Very consistent. They do very, very little acquisitions and dispositions every year, meaning acquiring businesses or selling off pieces of their business. What do the analysts have to say here? Earnings per share, whoa. That is basically nothing. They are not expected to grow earnings per share. I have to think that they're pricing in recession here. That has to be, I mean, even on the revenue side, you're extremely low through the next 2 years. I have to believe they're pricing in recession here. Well, let's do this ourselves. So this is the hard part about investing. You're looking at 10 years right now. Good return on invested capital over the last 5 years, about 9% over the last decade. Revenue growth. You know what? Let's say recession happens. They do 1% revenue growth over the next 10 years. 4 and 7. Let's say we go into a recession and we boom our way out of it, or the government prints a ton of money and gives it away to everybody and we do that again. Let's do profit margins of 5. Let's say they shrink. 8 and 11. Free cash flow margin, it's been very consistent around 8. I'm actually just going to go 8 across the board. PE, 15, 16, and 17. 15, 16, and 17. Desired annual return, 10, 12, and 14. Because I think that doing 7% revenue growth with 11% margins over the next decade, it's going to be a very big challenge. So it's currently $206 a share. I'm getting anywhere from 73 to 116, 147 to 202, and about 131 in the middle. I think I'm going to add this to my watch list around 145, maybe 150, somewhere in there. So guys, this was the earnings reaction video for Southwest, Mastercard, and Caterpillar. Tonight, we have Amazon and Intel. Subscribe to the channel, click the little alert button so you get it, and I'm going to do one later on around 4 o'clock. You guys have a fantastic day.